Thanks for joining us today on The Close. I'm Morello Fernandez. Markets close in 30 minutes. Let's get to the stories we're following out of the BNN Bloomberg newsroom. The U.S. Justice Department has reclassified state-regulated marijuana as a less dangerous drug. The directive moved licensed marijuana products from Schedule 1 to the less strictly controlled Schedule 3. Now, the move stops short of fully legalizing the drug for recreational use across the country, but it meets the demands of many advocates who have long argued for looser restrictions. Warner Brothers Discovery shareholders have voted overwhelmingly to approve a merger with Paramount Skydance. Despite widespread opposition to the deal in Hollywood, Paramount will buy Warner Brothers for $110 billion U.S., beating out Netflix in the bidding war. The deal still facing antitrust reviews in several jurisdictions. Shares of Lululemon falling after the company announced former Nike executive Heidi O'Neill will take over as CEO. O'Neill spent more than 20 years at Nike and is set to step into the role in September. She takes over at a tough time with weaker sales, rising competition, and a recent sizing controversy. Lululemon shares are down more than 35% over the past year. Here is where we are on the TSX right now, down 55 points, about 0.2 of 1%. And in the U.S., we are down in all the major markets. 0.4% down for the S&P 500, 1/3% down for the Dow Jones, 162-point drop there, and the Nasdaq down 0.9%, 218 points down on the day. So markets a little bit mixed today as investors digest the ever-changing news coming out of Iran. Let's go to Brian Balsky. He's the CEO and Chief Investment Officer at Humulus Investment Strategies. Thanks for joining us today.
Hey, Morella. Good afternoon, Canada. Thanks so much for having us.
We've seen oil and equities move up at the same time this week. I know the overall advice is often ignore the headlines, but is there a point, Brian, when that changes?
I think over a duration game, we'll use duration and convexity are two fixed income terms, not really for equities, but we need to see a duration of oil prices, we think, over $100 for a period of more than 6 months before you start to see and really feel demand destruction. That's kind of number one. Number two, really these markets, for all intents and purposes, Morella, since 2020 have been really momentum markets by the dip. And it's really paid to have a process and a discipline to keep you invested, because if you miss out on these moves, both on the upside and the downside, it's really hard to capture the old total return if you're trying to time it. So we would say control what you can control. I know that you led into the question about, when is enough and when do you have to really start focusing on the headlines? You should always look at the headlines, but at the end of the day, fundamentals matter. And we still think the fundamental condition of both Canadian stocks and U.S. stocks are in very good order.
All right. On that note, we are into earnings now. Are you seeing any immediate effects of the conflict play out so far?
No, not so far. It's a great question. In fact, U.S. earnings are going up. And one of the things that I find really interesting is one of the sectors that we really like in the United States are the financials. And financials are, I think, have been unjustly hurt with respect to what happened in private credit and private equity, or at least the fears of private credit and private equity. And I think from a thematic fundamental perspective, many investors are missing kind of the boat with respect to the scalable assets that big money center banks and asset managers and brokers can afford, what we think is going to be less regulation and more consolidation in the United States. Remember, for all intents and purposes, you have six banks in Canada. We have 4,000 banks and 600 publicly traded banks. So from our lens, it's a little bit too many banks, and I think we're going to see some consolidation, and we think that's a pretty strong theme for the next couple of years in U.S. financials.
Okay, you mentioned earnings are still pretty strong right now, but next quarter, of course, do you think they would be different? We could see the fallout. Travel stocks, for example, could take a very big hit.
Yeah, but three of the stocks I'm going to talk about are airline stocks, and oh my gosh, they continue to do quite well on the capacity side. But from the travel situation like Expedia and bookings, We own Expedia in our small mid-cap U.S. Portfolio, and it's been doing amazing. And from a travel side of things, people still going to go on vacation. Canadians aren't coming to the U.S., but they're certainly going to be going to Europe again this year. And we still see U.S. business travel, and especially on the international side, do very well. So at the end of the day, we think a lot of those fears have been moved. I think the thing you want to think about, Marilla, is maybe a change in how the consumer is going to be purchasing things. That's why we've liked more the defensive side of the consumer discretionary space and the retailers. But we think some restaurant stocks and some apparel stocks could do quite well the second half of the year.
Okay. Some of your stock picks here are about travel and about airlines, despite the concern about fuel taking a bigger bite out of their budget. You like United Airlines. Tell me why United.
Well, United has a great new fleet. They've got great routes on the international side of things. Their CEO, Scott Kirby, is an amazing CEO that's been very clear in terms of how they're doing things. It's about a $30 billion company in the United States. So we own it in our mid-cap portfolio. We've owned it for a long time. And we just think from an operational perspective, it's number 2 in the United States to Delta, which we're going to talk about next, I hope. But we think United, even if there's been some rumors on the American merger, where I think that's more noise, I think from a regulatory perspective, that would be hard to pull that off. But United as a standalone company is a very, very strong company.
Okay, so let's get to Delta, because I'm wondering how differently you are looking at the airlines in the U.S. versus the airlines in Canada.
Delta is the creme de la creme. And it's not because I'm a Minnesota kid and Delta merged with Northwest and all of that. Delta, from an operational perspective, from our lens, is not acting like a cyclical company. Airlines companies traditionally act like a cyclical company. In 2012, Marilla, Delta bought their own oil refinery. And so we've talked a lot about during this hit about oil prices. And I think a lot of investors don't understand that Delta has its own oil refinery. So from the sensitivity to oil prices is less relative to other airlines. But from their international side of things, from their routes into Asia, especially from Seattle and Detroit, and then Minneapolis and New York with respect to where they're going into Europe. So Delta is very, very strong. And in terms of the capacity, they've actually cut a little capacity. And I think that's going to be very strong heading into the summer months.
But do you see an airline like Air Canada very differently then?
Air Canada is very different. It's a $5 billion company. The PE ratio is double what Delta is. And before, what I said about United does not hold true for Air Canada. And what I mean is Air Canada clearly is still a very, very cyclical asset. And with their operations business and with their flight issues on delays, and how they handle the consumer. And oh, by the way, their biggest margins recently has been from international travel. Their domestic travel has not been great. So I do think that Air Canada is going to suffer relative to the U.S. We just like the U.S. airlines a lot better. And by far, Delta and United would be number 2.
Brian Balsky, sir, got to leave it there. Thank you for your time. I appreciate it.
Thank you.
All right. The tough talk flying across the border, all about trade. Back in a moment.
%50 tariff on steel, 50% tariff on aluminum, 25% tariff on automobiles, all the tariffs on forest products. Those are more than irritants. Those are violations of our trade deal. What we want to do is make progress as the whole. These issues such as decisions on which alcohol to put on the shelves, we can make progress very quickly on that, with progress with in other areas.
The Prime Minister outlining some of the issues on the table for the Kuzma review. Tough talk seems to be ramping up on both sides of the border. Let's start there with Jean Charest, member of the Canada-U.S. Advisory Council. Mr. Charest, thanks for joining us today.
Hello, Marilla.
So it feels like the tone of the Prime Minister and senior cabinet officials has kind of changed more recently on trade. Are we in a position to take a harder line if we still rely on the U.S. the way we do?
At one point, we have to, call things as they are. And the American side just isn't very shy about expressing their positions. I think it's done in a tone that's reasonable. And what the prime minister is saying is pretty straightforward. The American side saying give, 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 and pointing out that that's fine. We're ready to negotiate, but what about the tariffs you have that are damaging to our economy, to workers in Canada, and unjustifiable? And by the way, Morella, that hurt the American economy. I mean, this isn't a trivial issue. On aluminum, on steel, softwood lumber, cars, name it. They're hurting their own economy. So let's get serious, sit down, and have a good conversation about the future of CUSMA and move ahead.
Alcohol, of course, one of the irritants because some of the provinces have pulled American bottles off the shelves. Jameson Greer says he's considering launching enforcement action to deal with that, the U.S. trade rep there. Has that been raised officially, do you know, and what could that look like?
As far as I know, it's the first time it's ever been mentioned as enforcement. I'm not sure what it means. It points to one of the particular features of CUSMA. It has been negotiated, Morella, by the federal government, who are legally bounded by it, but not the provincial governments. In our federal system of government, the provinces are not bound by a trade agreement in the areas of their jurisdiction if they haven't signed on to it, which is not the case in CETA with Europe. In the case of Europe, the provinces have signed on, and so they are accountable and legally bound by the agreement. So I'm not sure what he means by enforcement. It's the provinces who decide what products are on the shelves. And as the Prime Minister's pointed out on all these issues, we can all make some progress fairly rapidly if there's a willingness on both sides to do so, and there is on the Canadian side.
Dairy, of course, has always been a problem, dairy restrictions in the country for imports. The U.S. wants some of these irritants to be dealt with, basically pulled back ahead of even sitting down for a review. Do you think Canada would make concessions just to get to that spot at the table?
We're not in a position to make concessions. We played in this movie before. We have responded to Americans under the Digital Act. We withdrew our own counter tariffs when they were out there. And by the way, the counter tariffs, to be very clear, Morella, and we were very much aware of that, were even harmful to our own economy. And so, initially we thought this is something that would be helpful. We came to the conclusion that no, and we withdrew them. And by the way, the same is true for the Americans imposing tariffs on themselves on steel and aluminum. So the question really here is, at one point, we need to sit down and have a good conversation. We know, Morella, that the American business community is in total support of maintaining CUSMA. Our supply chains are very, very much linked, and that's a characteristic of our trade relationship with the United States. So we want to have a broad conversation, a good one that's about mutual interest as opposed to one side asking the other side to give all the time without doing anything. And this is, I guess, it's the Trump method. But frankly, at this point, we know what it's about, and we are bound and determined to defend Canada's core interest.
Let me get your take on the Conservative leader's suggestion that perhaps Canada use something like critical minerals as leverage. As an example, are we in a position to do something like that? Would we consider something like that?
Well, let me first note that I think it's encouraging that the leader of the opposition, Pierre Poilievre, has been supportive of Canada in these negotiations. Yes, well, critical minerals is a big part of the deal. When the American administration says we don't need anything you have, we do know that the American side needs energy from Canada. That's one part of it. They produce 13.6 million barrels a day. They consume 20. We supply them 4 to 6 million barrels a day. Critical minerals, another very good example. And then this is something that is extremely important in the short term because of the hold that China has on the market. Canada has them all, whether it's rare earths, lithium, nickel, titanium, name it. I mean, we are the country that holds a lot of these minerals. Our view is let's work together to develop these minerals and supply American and Canadian companies that need them very badly.
You were on the other advisory council ahead of being chosen to stay on the council, which has been sort of reinvented here. Because of that position, I'm wondering if you have a different idea of why the U.S. treats Mexico very different from the way it deals with Canada. They've made progress. They've been much more open to having the conversations. Yeah. We've heard that time and time again. Why do you think that is?
Mariella, this is very straightforward. The agenda with Mexico and the United States is very different from the agenda between the United States and Canada. Think cartels, drugs, border, immigration, the presence of Chinese companies in Mexico. Very different set of circumstances. The Mexican side and Canadian side are in very close contact. We led a very successful delegation there. They are going to be coming here to Canada. We talk to each other. And at the end of the day, Marella, we may very well end up with a tripartite agreement, but also other bolt-ons on both sides, on Mexico and Canada. We're not offended by that. We don't think it's a bad idea as long as it works in the interest of Canada. So Mexico's a different story. And we're both going to defend our core interests and work together on things where we agree.
Jean Charest, got to leave it there, sir. Appreciate you joining us on The Close today.
Thank you, Marilla.
Let's get to this coming up next. Marijuana stocks in the spotlight after a major move from the U.S. Justice Department. Back in a moment. Cannabis stocks initially soared today on news from the U.S. that the drug is getting reclassified, but some of the enthusiasm fizzled when investors realized the limited scope of the change. Let's go to Boris Jordan, CEO and chairman of Curaleaf Holdings. He joins us now. Boris, thanks for your time.
It's good to be here. Thank you, Merle.
So the news initially was something your company, I know, has been waiting for a very long time. But because it's only state-approved cannabis that will be shifted from one classification to the other, does this announcement benefit you at all?
It's massively beneficial. It's a huge change to the industry. Companies, all of us that were paying, 70-something% taxes will now be paying normal taxes like any other corporation in the United States. The only thing that happened where there's a little bit of misunderstanding is that they're doing it in two parts. The first part was they rescheduled medical cannabis under the United Nations Single Convention on Narcotics, which can only address medical, and that was addressed today, and that's now finished. That represents almost 80% of Curaleaf's business. So it's a very, very substantial piece of our company. The adult use portion of the cannabis sector will be addressed in the DOJ hearings on June 29th, and going into the third quarter, we fully expect that to be rescheduled as well sometime in the third quarter before the midterms. So they're doing it in two steps because of the procedures that were set by President Biden. They had to do it that way in order to make sure that the ruling stuck and wasn't reversed in court.
Okay, so a couple of things. First of all, how much of your business is medical versus recreational?
So in the United States, we are over 60% medical business, and in Europe, we're 100% medical business, which for the whole company represents about 80% medical, 20% adult use. But in the U.S., 40% of our business, or a little bit less than 40% of our business, is adult use.
Okay, where are you operating? Where is your market operating in the U.S.? Where have you been able to distribute it to
We're
date?
in 17 states. We're the largest player globally in the cannabis space. Of any company. So we operate in 17 states in the United States, and we operate in about 9 countries in Europe.
Okay, so on the U.S. market, I'm guessing you've done your extrapolation. How big can you get in the U.S. market on the medical side?
Well, I think there's two things. The first is that obviously most of the states have moved beyond medical to adult use, and those programs are growing. So if you looked at our business 2 years ago, we were probably 90% medical in the United States. Today, we're just a bit over 60%. And with every year, the medical business has been falling. However, we fully expect that if for any reason, we don't expect this to happen, but if for any reason there was a situation where the federal government did not reschedule the adult use in the third quarter. Again, we fully expect them to do that. If they don't do that, then I suspect that many states will rebuild their cannabis programs around medical in order to give everybody a chance to benefit from the rescheduling.
Okay, but that being said, the way it is as it stands today, you mentioned medical is changing now. How much of a market
Yes.
are you able to capture in the U.S. with that one change today?
Well, as I said, we're talking about where we do 1.4, call it $1.4 billion of revenue, and 80% of that is medical.
Okay. I know you have been trying to position to be ready for the opportunity. Can you tell me what that looks like?
Well, I think that what you'll probably see from most of the cannabis companies is a restatement on their balance sheets of the tax liabilities that they had, which will really fix the balance sheets of most companies in the United States involved in the medical business. And obviously, I think this is just the first step in a lot of federal reform. One needs to understand that we haven't had any federal legislation on cannabis in the United States since Rohrabacher Farr about 15, 16 years ago. So this is the first time in 16 years that there's been any recognition of the sector from the federal government. And it's just the first step. As I said, in the next 3-4 months, we're going to have a second step addressing the adult use market, which again, I believe and many believe the decision on that will also be. The president has made a commitment to reschedule all of cannabis. So we anticipate that will happen in the third quarter. And then after that, we'll be looking to work with the federal authorities, particularly Treasury and Congress, on banking reform and uplisting to U.S. markets.
Okay, so that being said, because we had an idea that this was coming, have you moved to sort of ramp up your supply? Have you moved to secure other distribution points in the U.S., that kind of thing?
We haven't had to do that. Our business is very much built around both adult use and medical. We planned for this, so we didn't have to change much in our business in order to adjust to this situation. Really, it's going to be just a very large balance sheet fix, but also it's going to allow us to start doing research. Curaleaf does most of its cannabis research and our human trials that we're doing today on neuropathic pain medication in Europe, because we weren't allowed to do that in the United States because it was Schedule 1. Now we'll be able to bring all of that research and all of that drug development to the United States and work with the FDA because it'll be Schedule 3.
Okay.
That is a major change. That's one of the big changes that we have.
The stock, as you know, moved up today, and then this afternoon, it kind of fizzled. It's down over 20% right now. Do you think people are just not seeing the details of the announcement the way you have explained them?
Yes, I think that the main reason for the stock moving down is that we had the same thing happen in the fourth quarter. I think there's not a full understanding of what this actually means, and there's also the typical sell the news type of story. And the other thing is we've had no institutional participation in this market. I think that over the next several months, you're going to see more and more institutions starting to look at the sector and participating, and I think that will substantially revalue these companies.
Got to leave it there, Boris. Thanks for joining us. Appreciate your time, sir.
Thank you.
Coming up next, the closing bells, Bay Street and Wall Street. Here are the closing bells for the end of the trading day. At the Nasdaq today, Wing Venture Capital ringing the bell. And in New York, it's Neuberger Berman ringing the bell. At the TSX, Brompton Funds is closing the market. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The major markets ended the day in the red today. The TSX Composite not down much, 42-point drop on the day. The S&P 500 0.4%, or almost 30 points, 29.59. The Nasdaq down 0.9%, or 219 points on the day. Let's get to the movers in Toronto. Waste Connections leading the TSX today in gains, up over 8%. That is on earnings, moving the stock up $17.65 a share to $231.36. And also up on earnings today, Mullen Group, it's up 6.8% or $1.24. Bloomberg's Stephanie Hughes has more on both of those in just a moment. Let's get to the rail stocks. They are moving today as well. CP Kansas City up 5% or $5.62 today. And then CN Rail up 4.4 or $6.55 today. Both up alongside shares of two other major industry players, CSX and Union Pacific. Let's get to this. Curaleaf dropping today, 23% down or $1.24 loss. taking the stock price to $4. We heard from the CEO about a reclassification in the U.S. Details still being worked out, but that initially helped the stock and then dropped it down today. Discovery Silver is where we are looking next. It is down 7.5%. Shopify, 5.7% down. And then Constellation Software down 5.7% on the day. All right, let's get to Bloomberg's equities reporter, Stephanie Hughes. She joins us now. Stephanie, the earnings beat by Waste Connection. Tell us a bit more about that.
Yeah, Marella. So Waste Connections was the top performer on the TSX today for pretty much the entire trading session when shares gained by nearly 9% at their highest point. That brought the stock price that was the share's biggest move since September 2019. So it's been a while since we've seen a move of this magnitude. And that's because the waste management company's first quarter adjusted earnings of $1.23 per share came ahead of what analysts were expecting. And on top of that, it was also analysts who were covering the company were excited about the revenue beat and the beat in earnings before factors like interest, taxes, amortization, things like that. So also those EBITDA gains that I just referenced were enough to add back to the $80 million in impairments that were caused by landfill closure and the post-closure costs. So it did help the company become whole on that front, at least. Also, management said that they were gearing up for a pretty robust merger and acquisition year ahead, pointing to a robust pipeline, that is. So there's a lot of enthusiasm around that as well. So all in all, it seems like it was the earnings beat, the impairment recovery, and the M&A space and exuberance around that that really got analysts and investors excited about Waste Connections and really led to that run-up. So it turns out one man's trash really is a stock trader's treasure, Marella.
You've been waiting to say that all day, I'm sure. Okay, let's get to Mullen Group, which is gaining on earnings as well. Acquisitions helping them, I think.
Absolutely, yeah. It's another earnings-related high flyer. Mullen Group shares gained by over 6%, and that was enough of a run-up to bring the stock price to its highest level since early 2017. So it's an oil field and trucking services business. The company posted a modest adjusted earnings beat in its first quarter results posted this morning. But further to that, analysts and investors were really happy to see just what these earnings said about the market trends altogether. So analysts at National Bank gave a thumbs up to the results, saying that their view really came from the positive signs from the trucking market, which boosted their confidence that trucking rates would improve this year. On top of that, they said Mullen Group specifically is well positioned to benefit from the federal nation-building projects that are happening out west. And then once again, they pointed to the company being well positioned for merger and acquisition opportunities. So all in all, Mullen posted a modest adjusted earnings beat, and analysts are really expecting that Mullen Group can continue to build on those momentum given the positive signs that they're seeing in the trucking space right now. So that's why you're seeing that nice run up in shares so far, Marella.
Bloomberg's Stephanie Hughes with the latest out of Toronto. Thank you for the update. Let's go to mover south of the border. Bloomberg senior equities reporter Bailey Lipschultz is there and joins us now. Bailey, we'll start with United Rentals. The equipment rental company posted a pretty big earnings beat. Tell me about that.
Yeah, big earnings beat, and the interesting part was, according to analysts, really relatively clearing a low bar, as they put it, but you normally don't see stocks having their best days in more than a decade and climbing to 6-month highs if the bar is that low. So it was a big beat and raise as it relates to United Rentals. The big thing was really across the board demand, the management team talking about their ability to generate wins and growth, not only related to things like data centers, but also healthcare. So really seemingly firing on all cylinders, as you can see, recouping gains and getting back towards where it was trading in the fall at that recent peak. This also led a number of other companies in the industrial space to rally. So continuing with the theme that we've been talking about kind of ad nauseum over the last 12 months, the old economy stocks really outperforming. If they have an AI or data center flavor, even better. And United Rentals seeming to benefit from that. And it was the best performer on the S&P 500 by a pretty decent margin on a day that was a bit choppy from a broader macro standpoint.
Okay, let's get to Texas Instruments also reporting and had an upbeat forecast. How strong is the outlook?
Stronger than many were really penciling in. This is a stock that closed at a record high, really ability to continue to reinvent itself and build on that growth. As you can see, pretty robust, as they called it, earnings, but also a stock move really from where it was trading just a few weeks ago. This was the second best performer in the S&P 500. Again, one of those technology bellwethers. Obviously, people talk about the calculators, but when you're thinking about it from a chips perspective, Texas Instruments beating expectations, and again, really kind of delivering on what the outlook going forward could look like. So continuing to track the theme as it relates to some of these semiconductor stocks, memory chips, and kind of the entire ecosystem really outperforming and rallying while investors are shying away from software stocks.
Software stocks are next up. ServiceNow down after their earnings, and that helped to drag other software stocks down as well.
Yeah, I kind of walked myself there, I guess. So yeah, ServiceNow, at least on the headline numbers, beating expectations, but even management team acknowledging that maybe it wasn't a strong enough quarter that the Wall Street investors were hoping for. So again, beating maybe what the sell side put out, falling short of the whisper number. But as you can see, really tough stretch for this company, really tough stretch for the entire software space, the entire SaaS space, and management team will be the first to acknowledge that right now in the current ecosystem, the current dynamics, even if you're delivering on the top and bottom line, investors are still a bit wary to want to kind of bite off more than they potentially could chew as it relates to SaaS. So that is why you saw the stock under pressure. Again, it was the worst performer in the S&P 500. Yes, they did kind of beat in certain dynamics, but obviously there's a lot of uncertainty around what AI could do. LLMs and how they're going to potentially replace or at least make some of these companies trade at less lofty multiples. So this fundamental story, fundamental update, again, seemed better than most people were expecting, but at the same time, not quite enough to really drive people to go bottom fishing. But that's really been the story of software for the last 9 months, is how differentiated are you from kind of your peers, and also do you have a real moat that can protect you from the likes of a Claude or a ChatGPT, which again, they're continuing to unveil new models and new functionalities that are impacting pretty much any company.
Yeah, fears still exist, obviously, on that front. Bloomberg's Bailey Lipschultz, thanks for joining us. Appreciate it. Coming up, are there warning signs in the markets? Stay tuned. Markets are mixed today, ending the day in the red, up a little bit at the start of the day. But underneath the surface, apparently some big warning lights are flashing. That is according to our next guest. Joining us now is founder and CEO Darius Dale. He's with 42 Macro. Darius, thanks for your time.
Thank you, Marielle. It's great to be here. Appreciate you.
What's the warning sign you're seeing?
Well, the warning sign is very clearly the fact that the Strait of Hormuz remains closed. I don't think I'm breaking glass when I suggest that. There's very clearly a significant negative ramifications for the global liquidity cycle should the global supply chain cycle continue to be offline or at least severely impaired.
And this has been going on, of course, for over a month and a half. Are you beginning to feel like there are going to be much longer term effects than perhaps the market seems to buy into?
No, not yet. We're still in a risk-on market regime. I would feel that way if we transition back to a risk-off market regime. In our opinion, what's likely to catalyze that is a breaking of the ceasefire. Right now, the markets are giving the U.S. administration and the Iranian administration the benefit of the doubt as it relates to the negotiations and the brinksmanship. However, if we return back to kinetic warfare, that sort of area under the left side of the distribution of probable economic policy and market outcomes that was removed when they announced the ceasefire on April 7th, we would have to put that area back there under that curve, which would ultimately cause market outcomes to get significantly worse than they currently are priced.
Okay, so what is your timeline to see a change in the markets? And I'm asking because we all know the U.S. president came out early and said, oh, this will be days. Oh, okay, it'll be maybe a week or two. And that timeline keeps getting extended. At what point in that timeline do you start to worry about longer term weakness in the market?
Yeah, I mean, look, it's the market's job to determine that, not mine. I don't think anybody has an appropriate forecast on that. The one thing I will say, it really behooves us as investors to have high quality risk management signals, because this is the degree of sudden stop risk that is currently embedded in global financial markets and the global economy, in my opinion, is as high as it's been since about January of 2020 heading into COVID. This is the last time we've seen such a divergence between market prices and what could ultimately happen from a left tail distribution standpoint from an economic and a liquidity standpoint. And so ultimately, you're going to need some high quality risk management signals to get you out to the extent that these ceasefire discussions devolve more materially.
Okay, let's talk a little bit about tech, which has had a resurgence in the past couple of weeks, and AI build out, which we know over the last sort of 6 months of 2025 and the start of this year, CapEx was a big concern for investors. They wanted to see some return on revenue. When you look at what's happening now and that historic build out, what time in history can you compare it to?
Investors are not going to like this, but it very much reminds us of, in terms of our research process, of the work we did on the railroad CapEx cycle back in the 1850s to 1870s, the consumer durable goods CapEx cycles in the 1920s, as well as the internet technology CapEx cycle in the 1990s. And the thing that all three of those things have in common, those three CapEx cycles have in common, is that they were followed by secular bear markets. And so it's our belief that we're going to have a secular bear market at the end of this bull market run. But in our view, based on our fundamental research on the 5 key macro cycles of the outside of the positioning cycle, it's our view that the bull market continues, at least over the medium term. But at some point when we peak, that's probably going to be it for a while, for quite a long while.
Okay, let's talk about sectors that you like right now. Where are you putting money?
Yeah, sectors that we like. So in our opinion, assuming that we continue to get a reasonably positive resolution to the U.S.-Iran dynamic, then it's likely that our source of funds theme will go back on. Right now, it's off. We've been wrong on that theme in terms of investors flowing back into the perceived safety and the earnings durability of the mega cap tech trade. But in our opinion, if AI is appropriately diffused throughout the economy, which we believe it to be, then what's likely to happen is that we're going to see a convergence in the profitability and the productivity of sectors and factors that have been left behind. So from our perspective, if you pull up a 10-year chart of anything, you can very clearly see that international stocks, ex-US, emerging market stocks, cyclicals, small caps, these are all factors that have been left for dead because the tech sector was demonstrably outperforming them from a revenue, margin, cash flow generation perspective. But that's likely to converge over time as AI diffuses throughout those business models. Okay, so are there sectors you're staying away from? I mean, if you're in a risk-on market regime, you're naturally going to want to be staying away from low beta sectors like utilities, consumer staples, and healthcare and real estate. And those are the things that it's not that there's anything wrong with those sectors because they'll go up if the market goes up. But the reality is you tend to want to be long high beta cyclicals as a factor when you're in a risk-on market regime, as we currently are. Okay, we talked a little bit about the Iran conflict and what it means or could mean down the line. What about on the inflation front? How much of a hit do you think fuel prices will be on inflation in the next part of the year? Yeah, we already saw it. I mean, look, the rate of change of energy prices have to continue to rise for it to have an incremental impact on inflation. So in our opinion, when we look at our fundamental forecasting, we have 3 themes that are currently weighing on inflation from a core inflation standpoint, which is much more what the Fed is going to be focused on and other central banks around the world, starting with our productivity boom theme, our jobless recovery theme, and our cooling housing and labor theme. These are some pretty big weights in the core CPI basket that should continue to be an anchor on core inflation statistics and the kinds of statistics that Kevin Warsh were highlighting a couple of days ago, like trim mean PCE, trim mean CPI. And so from our perspective, we think there's a tremendous amount of downside surprise risk on inflation relative to consensus over the medium term, just as we believe there's a tremendous amount of upside surprise risk relative to consensus for growth. And that's a really positive backdrop for markets, assuming we can get a positive resolution to the conflict in the Middle East. Darius Dale, founder, CEO, 42 Macro. Thanks for your time. Appreciate it. Thank you. Appreciate you having me. Intel now releasing their first quarter earnings coming into the newsroom. Let's have a look at how the stock is doing after hours and what they shared. Stock up about 13% in after hours. So clearly investors are liking what they see. Shares for the company going up because the company says revenue will be $13.8 billion to $14.8 billion. Analysts on average had an estimate of $13 billion, so they beat that, and that was a Bloomberg analyst there. First quarter results, revenue at $13.58 billion, so 7.2% better year over year, and the estimate had been under that at 12.36. Intel's adjusted gross margin 41%. The estimate was 34.5, so very big difference there. And adjusted earnings per share coming in at 29 cents, which
is for the first quarter. We are going to take a quick break, but we'll get into some of these details with Ivana Delevska when we come back. Intel reporting first quarter results that are coming into the newsroom. Investors have been focused on how the company is doing as it tries to pivot its business. Let's go to Ivana Delevska. She joins us now. She is founder and chief investment officer at Spear Invest to talk about some of those results. Thanks for your time today.
Thanks for having me, Marla.
Okay, so let's talk about the revenue coming in, $13.8 to $14.8 billion for the latest quarter. What was the expectation here? How much better was that than believed?
Well, this is significantly above expectations, but Marilla, if you look at the outlook, that's coming even stronger than the beat for the current quarter. And the reason why this is happening is that we are going through a fundamental shift from in AI, where a lot of the compute was taking place on GPUs, to now it requiring a lot more CPUs. And that's really driving these results. And I think it's going to be sustainable, not just for Intel, but for the rest of the CPU players. You've seen big moves going into the results. So expectations were high, but they were able to beat those expectations regardless. And really the key for people to understand is that agentic AI is shifting the way we were doing, we were computing AI much more from model training to inference, but then inference requiring a lot more CPUs.
Okay, so I remember at one point, and correct me if I'm wrong, that Intel had trouble keeping up with the demand, right? It was trying to do the pivot and it wasn't able to be as productive as it hoped to be. Has that obstacle been removed at this point? Are they doing fine with that delivery?
Well, what's happening now, Marla, is the market is so tight that if you're not able to get your preferred vendor for CPUs, you're going to have to go to Intel, whether they're executing or not. So they're really at the sweet spot here, benefiting where people before may have had other options to consider. Right now, there are really no other options because all of the capacity is sold out. So this is why you're seeing companies like NVIDIA, which have traditionally been building on the ARM architecture, also be considering Intel. So we're seeing this trend continue and helping Intel, and it's really giving them a window to prove themselves and to be able to execute a little better. But you're spot on to say that they're still not really the best executor in the space, but this just gives them a little bit of runway to prove themselves.
Do you think a turning point for the company came with Washington's investment?
Well, absolutely. I think that was the start. And if you look back at that point, fundamentals post the announcement were basically the stock had moved way past the fundamental improvement. But the fundamentals are catching up, right? They seem to be turning around the fab side. They made a few announcements that indicated that now they're pivoting back to fab, and that could turn out to be a profitable business for them. And now with the CPU dynamics that are getting created, I think that's really going to help the CPU side of the business. So I think that was definitely a catalyst, but they are executing on their plan and making progress. So it's not surprising to see the stock kind of follow through post that initial pop.
Okay, so let's talk a little bit about who their customers are, because you mentioned the market is so tight right now that some are turning to Intel where they might not have turned to Intel in the past. Have they gained new clients?
Yeah, absolutely. So NVIDIA was a big new customer. That was a partnership that was announced earlier this year. The key with that partnership, when it was announced, it wasn't clear how much of their production or how much of their CPUs will they be using versus ARMs, because ARM is still going to be the dominant share for NVIDIA. NVIDIA, on a separate note, said that the CPU business for their company may turn out to be the biggest CPU business out there, right? So they are going to be using a lot of these chips. So I think the tightness is coming across the board. but really NVIDIA was one of the recent drivers for the business.
Okay, so good news for Intel today, but what challenges do you see ahead for the company?
Well, I think the key is going to be execution on the CPU side and whether they can keep gaining market share. Historically, they have been losing market share to the likes of AMD. So this is why we still prefer AMD as a play as well as ARM. So I think they do need to show some market share gains, not only participation, which is what they're showing right now, I believe. So I think that's really the biggest obstacle that they need to come through. And then the fab side is really where all eyes are going to be long-term, whether they're going to be able to turn this into a profitable business and compete with the likes of TSMC. They're still much less profitable than TSMC, but there is some hope here with this turnaround.
Would you put money into Intel?
Not at this point, given how much the stock has run up. I think they're better placed in the other CPU vendors just because of the risk reward. I think you are taking significant execution risk with Intel versus with AMD and ARM, you're taking a little less execution risk. So we prefer for CPU plays ARM and AMD. But the CPU space, as I said, looks very attractive here. So I think if people were to put money, I definitely wouldn't discourage them from that.
Ivana Zalewska is founder and chief investment officer of Spear Invest. Ivana, thank you as always. Coming up next, Lululemon shares sinking today after the company announced a new CEO. Back in a moment. Lululemon tumbled after it announced the appointment of Heidi O'Neill as the new CEO. She'll take over in September. Let's get some perspective on this. Janine Stichter joins us now. She's Managing Director of Consumer Retail at BTIG. Thanks for joining us today.
Thanks for having me.
So investors clearly not impressed with this decision. What's your take on the appointment?
Yeah, I think this appointment really caught people out of left field. There were a number of candidates that were thrown around throughout this process and talked about as being the potential successor to Calvin McDonald, and she really wasn't one of them. And I think on the surface, as people digest this, they're looking at the fact that she spent 20 plus years at Nike, including what was most recently a really challenging period for them. She was there for that. She was a large part of that. So they're looking at this and seeing the parallels between what happened at Nike and what's going on at Lululemon and saying, why is this the right person to lead the company? And then on top of that, she has public company experience, but not public company CEO experience. And she also doesn't start till September. So I think at first, this was a lot to digest for people who weren't really expecting her as the successor.
Okay, so what do you think is the biggest challenge before her?
Right now, she's at a point where there's a lot going on at Lululemon, but product and innovation is at the forefront of what needs to be fixed. So she needs to come in, and she doesn't start till September, but I'm sure she'll be formulating in the meantime and find a way to really drive that innovation and take a customer who's found little reason to shop with Lulu over the last 1 to 2 years, particularly in North America, and give them reason to shop. So it really comes down to product and brand. And I think the brand is really where she excels based on her tenure at Nike. Product, a little bit more of a question mark in our minds, not knowing how much product experience she really has. We think Nike is more of a brand company than necessarily a product company, and we'll have to see what she can do on the product side.
Yeah, design will be a big one for her that she has to handle. You mentioned her time at Nike, which was not a great time for the company. Were there any other takeaways from her time there? And does it give you any idea of how she'll handle this new job?
Well, I think we'll have to look and say, certainly the last 5 or 6 years at Nike have not been great, and she was there for that. She was a big part of that. But she's been at Nike for over 20 years. There was a whole period there where she clearly was very successful in her role. She rose to the ranks of the company, and there was a lot of good that happened during that time. And I think in speaking to management at Lulu and trying to understand why they put Heidi O'Neill in place, it was really the experience in taking Nike from $9 billion to $45 billion. And if you look at Lululemon right now, they're an $11 billion company, and they're saying we really need someone who has that global leadership experience to take us to the next threshold of revenue growth. So I think the fact that she has global experience across footwear and apparel, she's led large global teams, that's someone who can take a brand that's already had a lot of growth and does have a lot of scale and take it to the next level.
Okay, let me ask you, Janine, about the sales in North America, which have been dragging. They are doing better in some of the other markets like China, but what is holding them back in the North American market? Is it the competition?
I think it's a combination of factors. Competition is certainly part of it. There are companies that are growing and strong that were not present 10 years ago, like Alo and Viore are the ones that come up most frequently, but there's plenty more who have started to eat into the market. But I think it also the company needs to look inward and say, how much is this competition versus execution? And to us, the bigger issue is execution. Certainly, it's a more mature market in North America than it is in China. So that's going to play into the amount of the level that they can grow revenue. But there's also just been execution missteps on the product and also in coordinating the product with the marketing, with the in-store presentation. There's just been kind of that missing factor where they haven't been able to tie it all together and give the consumer something compelling. When you have a market that is fairly mature, execution becomes all that more important versus in Asia and in Europe where they're still newer, there's still more room for growth, even if they're not executing perfectly.
Chip Wilson, of course, former founder and used to be with the company, no longer is, but is very vocal about what he wants to see happen as far as leadership goes, board changes, that kind of thing. Would the placement of Heidi O'Neill as CEO sort of quell the criticism from him?
We have not yet heard from Chip yet post the announcement of Heidi O'Neill. I know everyone's waiting to hear what his thoughts are, but our view is that this will kind of actually add some fuel to his fire. Picking a CEO who's coming from a place that has a lot of the same challenges that Lulu has, I think he was hoping for someone that was a little bit more of a turnaround specialist, someone with more experience, maybe outside the athletic space. And our interpretation is that he will probably not like this appointment, and this will probably add fuel to his fire.
You've got a buy rating on the stock. What's your price target? And tell me where your optimism is coming from.
Yeah, so we have a $225 price target. We do have a buy. And look, this comes from, number one, valuation. You're at trough multiples for this company. You rarely get opportunities to own companies that are still quality, growing, strong margins, still have a growth runway at this type of multiple. And then secondly, coming back to the execution opportunity, I think the bear case will say they're mature and they're saturated and it's just going to be hard for them to grow. We point to what have been constant execution errors. And we've seen it in very obvious examples like the breeze through pant that they had to pull last year or the get low pant that they pulled earlier this year. There's been obvious errors in execution. And I think there's more self-help opportunity here than the market gives this story credit for.
Can I ask you behind the scenes if you're hearing what that story looks like? I'm hearing that perhaps there needs to be some work sort of just to boost the staff and sort of create a smoother platform for people to work behind the scenes.
Yeah, we've heard the same thing. From what we've heard, the organization has gotten very big, which can be a good thing, but it's also gotten very big and siloed. And when we think of some of the examples I just brought up on the product side, I think those things don't happen when you have an organization where the product team and the quality assurance team and the marketing team are all working together and aligned and talking to each other. And maybe that's where Heidi comes in because she does have experience leading these large global teams at scale. And it feels like there's been missteps internally that have probably led to weaker morale that could have been done more smoothly if someone else was leading.
Janine Stichter, appreciate you joining us. Thanks so much for your time.
Thank you.
Coming up, IBM beat expectations in the first quarter, but the stock still took a hit. We'll find out why when we come back. IBM has reported better than expected first quarter results, but shares slid as investors weigh ongoing uncertainty, particularly around how AI could affect the company's core business. For more, we were joined by Ross Gerber, President and CEO, Gerber Kawasaki Wealth and Investment Management.
We own a little bit of IBM here at GK, and it's in my fund. And, we actually reduced our position, over the last couple of weeks, kind of worried about some of the issues that the market clearly is still worried about and why it's being sold off, which is, their consulting business. And it's such a big, diversified company. And if just one area of their business is impacted negatively because of AI, it's really sort of bringing down the whole. So overall, they had great numbers, but there's just a lot of concern about the future of consulting and software. And I think it's legitimate.
You do think it's legitimate. So what is this the start of something then for IBM? Like that trend is going to continue downward, do you think?
Not necessarily, because the way IBM has their customer base is it's large enterprise businesses that really it's very difficult for them to switch providers. So I think it's really about, as companies transition to AI, I think IBM actually is in a good place to help their customers transition to AI and build the kind of hardware and security, which is, I think, ultimately what makes IBM interesting, is building something that's secure for large enterprises. Because, one of the things and risks of AI is AI hacking now, and that's the issue with Mythos and Anthropic. So, I think IBM will be fine in this, and it has had a little bit higher valuation than average recently, and so I don't look at this as too much. But I also don't think IBM's the leader in AI, so that's the problem.
Yeah, and it is disconcerting when we see Mythos get hacked itself. I mean,
yeah.
And it didn't take
we're
much.
just at the beginning, I think, of a cybersecurity nightmare. So, we've been looking at cybersecurity for AI, like who's really, we own some CrowdStrike and we like this play, but boy, we're moving into a whole new level of risk, especially with a lot of antiquated software out there.
And with IBM, with their software unit, what would have convinced people that maybe things are okay? I mean, they meet estimates, right? They met estimates essentially in line, but that wasn't enough for people.
Well, it's kind of like the Netflix thing where you beat all your numbers and then you don't raise your guidance, and then you're punished like you've done something wrong because you don't want to set expectations too high. CEOs get no advantage setting expectations high. And so I call it the Tim Cook, Tim started this, where you just set the expectations low every quarter. Maybe you get hit for a day or two, but as you get into your earnings reports, down the next quarter, you're not, misleading people, and then you can beat, and then you get the rally. So, it wouldn't surprise me to see IBM rally in the next earnings report after they report, or Netflix for that matter.
And was it people just staying away, or was it people looking at AI going, how can we incorporate this before we buy some IBM that we might need?
You mean regarding
the sales,
the company? Or
the sales. Buying,
no, sales were good. Sales are solid at IBM. They're all up, and we're talking double-digit growth at Red Hat, and this is a big company, so it's not Microsoft, but it's certainly doing quite well. And the stock market and company financials don't line up every day. Like a company could be doing well financially, and the stock price can move all around over the course of a quarter, for example. But I think when you look over time, that's how stocks gain value, is with rising earnings. So IBM reported a good quarter. Investors have a chance, if they want to buy IBM, it's a cheaper stock now, right? But at the same respect, this isn't a stock I'm buying right now, and it's a hold at our firm. If not, I just reduced some, as I just said, and we own it, but it's not the name I'm most excited about by far, and I think there's a lot of risk. And a lot of the reason we own IBM is because of quantum computing as well.
Mm-hmm. Which is, where are they fitting in with quantum computing? Let's ask about that.
They're kind of the leader. A lot of people don't realize that Google and IBM are actually the leaders in developing quantum computing systems, as well as the fact that, IBM is kind of one of the creators of AI when you go back in history. So they were doing machine learning before anybody else. So IBM has a natural advantage. They're just not a very fast-moving, innovative company because they're so big and sort of that's their history. They're just not that fast moving.
And would quantum computing be something that might take you out of the hold pattern?
I think it's a long-term thing, and my research in quantum, just briefly that I dove into it, I was like, okay, this is something that's going to take years to really develop, so I'm not too concerned about it. But what it is that they have this edge in their businesses through their experiences with quantum and AI, where they can really continue to develop. And because they manage, large mainframes and software and consulting, they really have a full stack solution for big companies that want to implement, technology. But I think it's mostly the risk that their technology is antiquated compared to the startups and the new companies that are coming around, pitching companies.
So you're waiting then to see the AI shakedown with it, or may there be a moment that draws you in?
Well, I think, we originally bought IBM based off this premise that they are sort of the core original leader and a foundational company in databases and software and hardware. So, it would make sense for them to benefit in this era. I think it's about execution. And so we didn't dislike the quarter. I wasn't in love with the quarter either. But, I'm also not like selling the stock now. We sold off some, over the last couple weeks, actually to reinvest in Micron, which I think is a much more compelling name. So, that's part of the game too, is it as compelling as some of the other investments out there, and it's not. So that's why it's a smaller position for us.
Ross Gerber, our guest there. Coming up, hot picks. We'll dive into 3 REITs in a moment. Time now for hot picks, and we looked at 3 REIT plays that our guest says are positioned for meaningful growth. We got more from Lauren Kalmar, real estate analyst, Desjardins.
Primaris is probably our top pick in the entire space. And for those who don't know, Primaris owns about 30 enclosed malls. Previously, malls had been in the category of persona non grata. And as we've come out of the pandemic, the story around malls has significantly improved. The PMZ has significantly altered the composition of its portfolio via acquisitions, largely of pension fund-owned malls. And ultimately, what you have now is a REIT with a peer-leading organic growth profile and ultimately a peer-leading earnings growth profile. You have a company that has an extensive acquisition opportunity set, significant upside through the sale or monetization of excess density at some of these malls. You've got a REIT with a peer-leading balance sheet. It's got the best balance sheet in our coverage universe. That's on a net debt to EBITDA basis, about 6 times. And I think you've also got a really well-respected, well-rounded management team. And they recently bolstered their bench with the addition of Julian Schoenfeld to CIO, and he came over from CapREIT. And then despite all this good stuff you have going on, or great stuff you have going on, they're still trading at what I would call a bargain, basement bargain discount. They are trading at the lowest earnings multiple on FFO of any of the large cap REITs in our coverage. They're trading at about a 30-35% discount to NAV. And we just think the confluence of the earnings catalyst, the growth catalyst, combined with the valuation discount really presents a unique opportunity to generate outsized returns here in the next little while.
And I guess the retail REIT space, investors certainly were inspired to look at it more closely with this takeover of First Capital by KingSett and Choice Properties.
Yeah, so I unfortunately I have to be a little careful about what I say around this because we are research restricted as we advised KingSett on the deal.
Sure.
But certainly from taking a step back from the retail space and the REIT sector more broadly, it's obviously fantastic to see a deal. This deal was done above NAV, which is something we hadn't really seen in the last few deals that had come to fruition in the REIT space. And one of the big catalysts we've been waiting for is to get the generalist investors' eyes back on the space, and that's both the Canadian generalist, it also includes the U.S. REIT investors and U.S. generalists, because that's what's really going to move the needle. So we're really hopeful that this deal does exactly that.
Your next idea is Sienna Senior Living. Now, I know we can't get into all the technicalities, but is this actually a REIT?
Fair point. It is technically not a REIT. It is a corp, but they do own retirement homes and long-term care homes.
Yes.
There is a significant operating component to the business, which is a little bit different than the commercial REITs that we cover, but it does fall under our purview. It is considered real estate.
Sure.
And, it's Sienna and Chartwell are the two. The big difference between them is Chartwell is pure play retirement, whereas Sienna is, call it, roughly a 50-50 split between retirement and long-term care.
Right. And certainly it has a yield north of 4%, so it's very like a REIT, I know.
Yes, in that regard, absolutely. The cash flows are fairly stable. I mean, the LTC business is almost more like infrastructure. You're government funded. You're virtually guaranteed to be 100% occupied, and typically revenue growth tracks in line with inflation. Now, this had been a sector that was, as I'm sure many people are aware, hit exceptionally hard during the pandemic. To the credit of the government, they really made a concerted effort to right-size the funding to reset the sector back to what it had historically been, right, which was this bond-like type of asset class, and that's where we are today. But what I think makes the long-term care business particularly interesting right now is the redevelopment side. So for context, there's a lot of older homes, built in the 60s, 70s, that are no longer considered serviceable. And as a result, the government, particularly in Ontario, has put together a program to build or redevelop about 58,000 beds. And as part of that, half of this is basically redevelopment of the older stock. And one of the big issues that the sector had faced, or this program had faced, is in higher cost regions like the GTA, particularly where land costs are significantly higher, the program wasn't sufficient for the developers to get yields that would hurdle. And as a result, you weren't seeing projects built in the GTA, which, as Ontario's most populous region, desperately needs them. So last year, they dramatically enhanced the funding. They basically doubled it. And as a result, we've seen a big increase in the amount of development starts and projects moving forward in the GTA. And Sienna, which has a big Class C bed portfolio, about 2,000 beds, 80% of that's in the GTA. So with that program being augmented as it was to allow the redevelopment of these homes, it's a significant opportunity for Sienna. And they actually just announced their first GTA redevelopment, about 450 beds, when they reported results back in February.
And then finally, RioCan, we're back to retail REITs. Tell us what's the attraction of RioCan? I mean, obviously, it's been the giant of the sector for a long time.
Yeah, and it's had its trials and tribulations. There were concerns around condos, and then you had in 2024 there was a wave of bankruptcies early in the year that hurt it, and then obviously we had the HBC bankruptcy last year. But we really think in 2026 and beyond, the company is well positioned to get back to basics. They are selling out of their multifamily assets. The HBC story is largely behind them. They've effectively dealt with the vast majority of the 10, 11 locations that they had. It was a little bit more complicated because it was a joint venture that they had, as opposed to a Primaris, as an example, where HBC was just a tenant. But that seems to be heading into the rearview mirror. And what they've done is they've recently introduced a core FFO metric, which basically excludes anything related to condo sales, to the apartment portfolio, as well as HBC. And that should give investors a much clearer idea of the underlying earnings power and productivity of the core business, which I think is where they ultimately want to get to. Core FFO is effectively an aspirational FFO for them. And we see a real path to simplifying the business or continuing to simplify the business, I should say, over the next, 12 to 18 months. And at that point, you've got really the only large cap retail REIT left in Canada with the FCR acquisition happening that doesn't have a sponsor or significant shareholder. And we think that presents a really unique value or a very unique opportunity for Canadian investors. And, much like Primaris, this is another REIT that still continues to trade at a not as significant of a discount, but certainly in the context of the retail REITs, which have traded up quite a bit, still at a relative discount to its peers and a relative discount to where it's traded on the long-term average. And we frankly think that if all this comes to fruition, that gap should close, and there's some good upside there.
Lauren Kalmar is a real estate analyst at Desjardins. Let's have a last look at the markets and how they ended the day. A streak of red for the North American markets. Q1's here. The TSX Composite down 42 points today, so about 0.1%. The S&P 500 took a 29-point drop. 0.4%. And the NASDAQ, a 219-point drop on the day, 0.9%. A few factors moving today. Still no clarity on the conflict in Iran. The ceasefire right now seems to be holding, but people are unclear what it means for oil prices further down the line, and a resurgence in the tech stock, with tech stocks coming back into interest for a lot of investors. That does it for the close today. Thanks for joining us. We'll see you back here tomorrow.